She took out a $500, 900% interest payday loan. You borrow $1,000 for this one, you pay back a total of $4,413.
I'm Kevin, a certified financial planner, and today I'm reacting to viral YouTube and TikTok clips. We'll then be grading them from A to F, depending on how good the advice is. Let's go.
The 401k is a trap. I'll prove it to you. We are right now sitting on the lowest tax rates we've ever had in the history of the United States. I'm not sure if you know that. That being said, because the tax rates are the lowest that they've ever been, I have a question for you. Do you think that taxes are going to go up in the future? I'm sure your answer is yes. So if you put money into a tax-deferred 401k plan, you're essentially saying, I want to save money on taxes right now, but then I'm just going to let that money go get taxed at a higher tax rate later when I pull it out in retirement.
All right, let's just stop it right there quick. So again, the point of deferring your taxes until retirement is that a lot of people have a lower tax bracket in retirement because they're not working anymore. So again, a fundamental misunderstanding of what's going on here. And again, the point is to let that money, compound over time, take it out at that lower tax bracket, and then you also are getting that current year tax deduction while you're working. So, if you're in a higher tax bracket while you're working, that tax deduction is pretty nice. So again, this guy seems to have a very fundamental misunderstanding of how the taxes work with 401ks, or is intentionally trying to mislead people, probably trying to sell something. But again, even if you do have to take what he's saying at face value, there are Roth 401ks. If you really don't want to get taxed when you take it out, get a Roth 401k if your plan offers it or contribute to one, But let's see what he says here.
When you pull that money out when you're 59 and a half, do you think your tax rates are going to be higher than where they are today in 2024? If your answer is yes, why are you stuffing so much money into your 401k without a plan? Build your strategy.
Yeah, build your strategy, probably trying to sell you something. So again, this is going to be an F because, like I mentioned, tax deferred growth is a great thing, especially if you have a high income currently, you're taking that tax deduction, it's really nice. And if you're in a lower tax bracket in retirement, it's getting a lower taxable income on those deferred gains. So again, putting money to your 401k is not a bad thing. Unfortunately, these financial gurus have been trying to push that recently. Your 401k is awesome. This doesn't even include the fact that you get like a match and all these other great things. So again, this is enough. Let's go to the next one.
What is the best financial advice you've ever received?
Invest in assets, not liabilities.
What is the worst financial advice you've ever received?
The way to build wealth is saving your money.
So true. Third question. What is something you used to value that you don't anymore?
Material things.
What is something that you think people think is important when it comes to money, but you realize that's not really the right focus?
Net worth. Net worth is a crap indicator of real success.
Okay, so a few different things here. This is some good things and there are some bad things. The first thing he mentioned was, hey, invest in assets, not liabilities. Totally agree with that. I think that's a good path forward to wealth, is investing in things that appreciate over time and not things that are counting against you. And then he mentioned, though, that the worst financial advice he's ever heard is that saving is like a good way to build your wealth or whatnot. He said, that's bad advice. I mean, saving is a great way to build wealth. Again, you're not gonna, put your money in like a savings account or checkings and it's gonna be millions and millions of dollars one day. You're supposed to be investing in, like you said in the first part, in assets. But to get there, you gotta save. So again, kind of good, kind of bad here, a little mixed. But the last thing you mentioned, the net worth, net worth is a very good indicator of how you are doing financially. That's a fact. There's a question about like maybe sort of like the emotional side of things, I guess you could say, where, just having a high net worth doesn't mean, you're living a good life, whatever that means to you. But financially, yes, your net worth is a very important thing. So again, some truths, some very misleading things in there. I'm going to give this a C because, again, I think he's got the good intentions and I think he's probably got most of it right, but definitely a couple of things there that could be fixed.
Investing has kind of been solved, but most people are still doing it wrong. It's been solved because simply capturing market returns using low-cost index funds is a close approximation of optimal for most investors. You can do this easily with a single ETF in Canada, but most people are still doing it wrong because humans are not wired for long-term thinking. People worry about short-term returns even if they're themselves long-term investors. They chase the returns of exciting assets, and they overestimate the probability of the next big market crash. Investing has been solved, but solving investor behavior is a lot harder.
Amen. This is absolutely spot on. I'm already going to give this an A here. I mean, this is just spot on advice. I mean, it's just true. You know, the behavioral side of finance is so important. And like you said, a total cost or total market low cost index fund, like in the US, I know VTI is a good example. That is probably the optimal investment for the vast majority of people. Again, there are nuances, obviously. Everyone's got a slightly different financial path, your age, your risk tolerance, risk capacity. All these things matter a lot, but for the average person, I think most people, something like VTI, a total market low cost index fund, is a very optimal investment indeed. So yeah, this is spot on. You know, the behavioral side is the tricky part. And you know, I think that's actually why financial advisors still exist, is because that behavioral side is something that a lot of people, we may never be able to figure that out as humans until, I don't know, we're a lot more integrated with AI or something. So yeah, Ben Felix, you know, he's one of my top guys that I listen to out of Canada, and he gives some really solid advice. So A+ here.
If you want to retire early, don't max out your 401k. Do this instead. A 401k is a great way to invest and get tax-free contributions, and you should definitely get the match. But the issue with the 401k is that your money is locked up until age 51.
All right, I gotta pause it quick. So he's starting off saying that you should not contribute or max out your 401k. Please don't listen to that. If you're able to max out your 401k, it's probably a good idea to do so. We know in America, it's one of the first accounts that Americans get to that 7-figure mark, if not the only account that gets that 7-figure mark. So right off the bat, this has already given a bad taste in my mouth, but we're gonna let him finish here and see what else he has to say. However, he is mentioning that 401k match, which is a good thing. It's very crucial to get. He also said tax-free contributions. That's not really a terminology that we would use. You know, when you do a contribution into a tax-deferred 401k, you get a tax deduction. We wouldn't call that a tax-free contribution. So a little weird on the use of terminology here. I think he's maybe getting a couple things mixed up. But let's let him cook here.
So if you're like me and you want to retire before 59 and a half, maxing out your 401k is not the best way to get there. So here's the order of operations that I would recommend. First, get your 401k match. It's basically free money. Then I would max out my Roth IRA, max this time. And then the third thing I would do is just pump money into a brokerage account. The reason why
All right, so here's what I would do. First, I would get the highest deductible covered in your, in your general financial plan, because you need something to have a cushion, sort of like an emergency fund, if things get thrown at you in life, which they will. I would then go over that 401k match, because that is free money. There's absolutely no reason not to get that. Step 3 for me wouldn't be max out the Roth IRA. In my view, I would instead be paying off high interest debt. So credit cards, high consumer loans, personal loans, card debt if it's at high enough interest rate. So if you're, paying a credit card company 25%, and you're hoping to earn like 8 to 9% in the stock market, I mean, I don't need to tell you the math on that. So it doesn't make sense to do that. So of course, he's got a few things right here in a sense, but he's got sort of a weird way to put them. And then he mentions the brokerage account. When we look at retirement, we want to have people we want to have Roth assets, we want the tax deferred assets, and we want the after tax brokerage assets as well. We want all three of those to be filled up as in buckets, you could say. He's saying just to put as much money as you can into these brokerage accounts. This is a really tax inefficient way to do this. I mean, if you're pumping all this money into this brokerage account, the benefit is, yes, you get withdraw that money at basically any time, but you have to create a taxable event by selling those assets. Again, nothing against brokerage accounts, but there's probably a more tax efficient way to do it. Let's also correct the fact that your money's not really locked up till 59 and a half always in a 401k. There is the rule of 55 where you can get access to it even earlier. So a couple things are right here. He seems to I don't know if this is like ChatGPT or some things he just researched online and just kind of got them jumbled together, but he's got a few things kind of correct and a few things wrong. But let's let him completely finish this video out, and then let's see if he's added in anything else.
The brokerage is important is that you can withdraw that money at any age. It's not locked up until 59 and a half like the 401k is. So your brokerage account is going to bridge the gap for your early retirement. So let's say you retire at 50, you can fund your lifestyle with your brokerage for 9.5 years, and then it'll be time for your 401k to kick in to fund it at 59 and a half. If you like this kind of stuff, comment what you want to see next and make sure you follow for more.
Yeah, guys, this is pretty bad advice. I mean, I'm gonna have to give this like a D just because there are a few nice things sprinkled in there. But again, maxing out your 401k is a very nice thing if you can do it. Not to mention, there are Roth 401ks, which, are a great thing as well if you can contribute to one of those. But if your income's high enough and you are, contributing to a tax-deferred 401k, that's a nice tax deduction. He didn't mention that. A nice tax deduction, nice reduction to your taxable income. Those are really nice things to have. So I think this guy is, I don't know if he's just trying to do this clickbaity thing where it's like, hey, don't invest or max out your 401k. But I would have to say this is pretty bad advice here. I'm going to have to give this like a D.
We're on the verge of a major market crash. If you are expecting the markets to continue up, you need to look at these three things right now, because these three things are not what you want to see if you expect the markets to continue up. First thing, 54.6% of consumers think that the markets will continue up over the next 12 months. This is the most we have had in decades. Anytime retail is betting this big on the markets going up, we always want to be careful, because usually you're going to see a correction. Next thing right here. Bank tightening. Anytime we've gone through a tightening cycle like this with credit and we've loosened, we've always gone into a recession. So right now they're saying there's no recession, but you need to pay attention, because if you look at this chart, it has always ended with a recession. 2008, 2020, so on and so forth. Next thing, Dow Jones. 9 consecutive red days. We have not seen this since 1978. Don't want to just ignore this. 1978, that's a long time to go without having 9 red days with the Dow Jones. There's a lot of signals out there showing that the markets are going to correct. Market crashes can be great opportunities if you position yourself smartly for them.
Okay, so this is your standard, I think I can predict the stock market. Let me give you a bunch of random correlations that really don't mean anything, that don't mean causation. I can say I see a cloud that looks like a cat, and it happens to have been on the stock market crash day. Does that mean every time I see a cloud that looks like a cat, the stock market's going to crash? Of course not. So we can pull out all these different things, and while there are legitimate things that can, be leading indicators to how the economy could possibly do, I think when it comes to the stock market, trying to predict what's going to happen is a fool's game. And again, these different things that he's mentioning, these things are pretty irrelevant, especially that last one. That is like crazy. I mean, when you pull up the stock market on a trading chart, you could point out just like thousands of different things that probably haven't happened in like 50 years and say, oh, it didn't happen until the Great Depression, so we're going to go through another Great Depression. I mean, it's silly. So we do know that time in the markets beats timing the market, which it sounds like this guy's trying to do. I will say the one last thing he said at the end there was nice to hear, which is like, hey, if the market crashes, you can try to position yourself to buy in at lower prices. Again, if you have a bunch of cash sitting around, and the market is truly crashing, sure, you can deploy it, but most people probably would be better off just dollar cost averaging into the market, and then that way they're buying in whether it's higher or lower. Because another fact of data is that the stock market makes all-time highs pretty regularly. So you might think that you're doing well by buying when the market's lower, but when the market's at all-time highs, a lot of times it just keeps going higher. So again, this is just sort of a ridiculous take in my opinion. I think this is just trying to predict something that you can't really predict. So this one's gonna have to be an F, unfortunately. Let's go to the next. Okay, so all of these stocks are going to be included in the S&P 500. So, while I guess this is interesting little piece of information, it's not really a surprise, because if you're investing in the stock market, you're almost certainly going to own these companies in a way. I will just say though, for people watching this, don't try to go pick and choose which one of these companies is going to go do well over the next 5, 10, 20 years. You're much better off just owning like a total stock market index fund like VTI, or like an S&P 500 index fund like VU, something like that, low cost, own the market. All of these stocks are going to be in both of those funds. So you're much better off owning that than try to pick and choose which one is going to do well. But again, that's an interesting piece of information, I guess. But I would give this, I guess, a B. I don't really know. I don't really have a strong opinion either way. So it's nice to know. And on to the next one we go.
She took out a $500, 900% interest payday loan. You borrow $1,000 for this one, you pay back a total of $4,413. For what?
We needed money for groceries.
Why did you take this out? Be real. Come on.
I bought a PlayStation 5. Really wanted one, and so
Nothing like collections for PS5s.
got a PlayStation 5.
Do you play it?
Yeah. All the time.
You should read a book.
Okay, so this one's almost comical just because of Caleb Hammer's reaction here. Obviously, this is quite literally one of the worst payday loans that I've seen. I mean, truly a 900% interest rate for what I think she financed $500. Again, she said groceries, there were those PlayStations. I don't know what was actually purchased, but it doesn't really matter because you took out such a hit on that financing that you would have been better off doing just about anything else than that. So it's actually truly criminal that these payday loans are even allowed to exist like this. And unfortunately, it takes advantage of people who are financially illiterate. And we can call her stupid, dumb, whatever Caleb probably called her, but financial literacy rates are not as high as they should be, and it's things like this are very troubling to see. So while there is a comedic side to this is truly sad to see that people fall into these debt traps because, I mean, $500 for like what, $4,500, $4,000 she got back. I mean, that's crazy. So again, in terms of financial prowess, that's an F minus.
Hi boss, I found a better job, so I quit. I'm gonna take the $5,000 in my 401k and go. Yeah, make that $0. What do you mean? The company offered me a 5% match. I'm entitled to that money. Guess you didn't read the fine print. We have a vesting schedule, meaning if you leave the company before 1 year, you get 0% of your 401k match. What? That's a thing? What if I stay here for another year? Then you would get 25% of your 401k match. Well, how long do I have to work here to get 100% of the match? At this company, you have to work here for 5 years. What? Is this a scam? No, actually only 28% of companies offer an immediate 401k match. We do this to keep you working here longer. Well, I'm glad I know this now. I'm definitely going to be asking about vesting schedules at my next job.
Okay, so a couple things we're writing here, little things were a little, maybe misleading a little bit. So the contributions, that's what you are putting into that 401k, your employee contributions into a 401k, that is immediately vested. So you're not subjected to this vesting schedule. She is correct in saying that your employer probably has some type of vesting schedule where only a certain amount of the money that they put in is going to be kept in that 401k if you are to leave your employer after a certain period of time. Now, one thing I do want to mention here, though, is that there are a lot of what we call safe harbor plans, which even the employer matches are going to be 100% invested immediately as well. But then there also are different employers who don't have that, where you're subjected to either a cliff or like a graded schedule. So a cliff would be, hey, you work here for 2 years, and then the third year, we're going to get you 100%. So it's 0, 0, and then 100% of those contributions from the employer. Where a graded might be like, hey, it's going to be 0, 20%, 40%, 60%, 80% in the 4th year, then the 5th year, 100% is yours. So she's correct in that sense. There's kind of that mix. I will say it is important to know, hey, which vesting schedule you're going to be a part of when you join these companies. So she's right in saying that. But we do want to remember the contributions you're putting in are immediately vested. So keep that in mind. So overall, I'd give this like a B. So if you got most of it right, maybe a little bit technical information, maybe like a B or B+. Overall, pretty good info.
Yo, I just signed up for our company 401k. That's cool. I signed up for the Roth 401k. Well, with my traditional 401k, I get a tax deduction this year, so I'll pay less in taxes. Well, mine is funded with after-tax dollars, so at least I don't have to pay taxes in retirement. Well, mine is funded with after-tax dollars. Shut up, dude. Don't get me started on your whack-ass shit. Whoa, guys. Break it up. We get it. Traditional 401k, pay taxes later. Roth 401k, pay taxes now. You're both great.
Okay, so this is accurate. We do know that with those pre-tax dollars, you're deferring the tax. So you're going to be paying the tax when you withdraw it in retirement. Where at the Roth IRA, you're paying the taxes now. That way in retirement, it's tax-free growth, unqualified distributions. So again, this is accurate, which is great to see. I like it when we have at least an accurate place to start. I will say that with most Roth 401ks, usually what they let you do is choose which bucket, how much you want to put into each one. So for example, maybe you're putting a few percent into your pre-tax 401k, and then for the Roth 401k, you're putting in a few percent or something like that. So usually they let you kind of choose. It's not, most of the time in my experience, you don't have to just choose one or the other. If you do have to choose one or the other, which again, I haven't seen that too often, but if that's the case, then you need to make a decision which would be the most beneficial for your taxes and for your long-term financial plan. If you're in a high tax bracket now, that pre-tax deduction for the year, that tax deduction is very crucial, and that could actually be a better method than the Roth. Again, the Roth is just so nice because you are getting that tax-free growth on those withdrawals in retirement for those distributions, which again is very hard to beat. So again, it does come down to your personal finances. There's not really a wrong answer here. And I can tell you, you're doing better than 99% of people who aren't doing either of them. So again, find out what's best for you, stick to it, and stay steady with it. Let's go to the next video. All right, guys, that's all I got for today, and I really appreciate it if you made it all the way through the video. And again, if you aren't already subscribed, please subscribe, as we're gonna really push out more personal finance content that I think is gonna help a ton of people. And let's not forget, if you can also like and leave a comment. I am looking for more content to react to, so if you have anything in mind, just let me know. And again, if you are looking for a certified financial planner pro to work with, just reach out to me at purewealth.com. Again, I would love to work with you and see if we would be a good fit. Again, thank you all so much for watching, and I'll catch you in the next video.